Hey folks, welcome back to the Investing Iguana channel. Today, I'm tackling a burning question that every Keppel DC REIT investor in Singapore has been wrestling with. Does the latest rights issue help or hurt your dividend yield? If you're staring at your CDP, wondering what those new unit rights mean for your next payout, grab a copy and settle in. This video is all about cracking the reality behind REIT dilution and data center growth. By the way, Iggy here, ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed 1 million views and have racked up 58,000 likes, not to mention over 1,000 videos and 600,000 hours watched. I always bring a Singapore and Southeast Asia lens, plus global insights, straight to your screen. Today's insights are adapted from my latest in-depth Substack deep dive, where I break down the maths, market moves, and pros and cons of the Keppel DC REIT rights issue. What will you get in this video? A full walkthrough, from the mechanics of the rights issue to the dividend impact, Tokyo data center 3-story, and my personal playbook for navigating the upcoming weeks. We'll cover it all, step by step. First, we'll look at the nuts and bolts of the rights issue. What's happening, why, and how it hits your portfolio. Second, we break down the dividend yield before, during, and after the new acquisition. Third, we step into Tokyo Data Center 3 and see why this asset matters. Fourth, we dig into capital structure changes and what interest rates mean for the REIT. Fifth, it's all about operational performance, risks, and investor choices. Last, I share my personal take as Iggy, give you practical strategies, and wrap up the key lessons. Let's dive in. Picture this. You're meeting your kaki at a local kopitiam, both looking at your Keppel DC REIT holdings on your phones. Suddenly, the notification pops up. Rights issue, 80 new units per 1,000 at $2.24 each. On the surface, that 6.3% discount looks tasty, doesn't it? But with every order of kopi, there's the extra ada kopi or kurang manis. Here, it's 8% dilution in your unit base. Miss out. Your percentage ownership slips away. Imagine you and your buddy both own 1,000 units. After this rights issue, the total units rise by 8%, diluting your claim unless you join in fully. Here's a quick breakdown. Rights issue gives you 80 new units for every 1,000 at $2.24, a nice discount compared to $2.39 market price. But those extra units mean your slice of the pie is thinner unless you pick up your full allocation. How would the table look if you saw it? Simple grid. Rights ratio, issue price, market price, discount, dilution percentage, total proceeds. Each point showing how your slice changes. Mid-video plug. For all full charts, checklists, and written playbook, grab this post on Substack. Link in description. Now you might be thinking, Iggy, will the dividends actually drop? Here's where the numbers tell a surprising story. Annualized dividend yield for H1 2025 sits at 430%. But in FY 2024, it was 4.34%. Post-acquisition, after Tokyo Data Center 3 climbs aboard, the pro forma yield lands at 4.06%. Looks lower, right? Breathe. That number includes both the dilution and the new income from the Japanese asset. Let's walk through an example. Sarah, an investor, holds Keppel DC REIT and is staring at these numbers. If Sarah does nothing, her yield sinks. But if she participates, her per unit income stays competitive. And she gets a slightly bigger slice thanks to the accretive new asset. Quick spoken table summary. You'd see 3 lines. Current yield, 4.30%. Last year, 4.34%. After acquisition, 4.06%. Yes, the yield compresses a touch, but the total income pool is larger, making up for the extra units. If you want all the visuals, they're live on Substack for paid members. Think of Tokyo Data Center 3 as that prized sushi restaurant with a 15-year lease in the heart of Inzai City, Japan's equivalent of our Taiseng data hub. The tenant here isn't any regular. It's a global hyperscaler, locked in for the long haul with annual rent escalations. Like booking a table every month for the next 15 years. Steady cash flow you can rely on. This property brings strategic value. It's Tier 3, earthquake resistant, connected to Tokyo's networks, and ready for AI workloads. Liquid cooling included. For Keppel DC, it's not just adding another shop front, but securing a stable, growing revenue stream. See the portfolio table in the written post. Old occupancy versus new. Whaley, weighted average lease expiry, stretching to 7.2 years. Total assets rising 14%. Why does the REIT need this big pile of fundraising? Simple. It's 404.5 million split between buying Tokyo DC3, improving local Singapore data center assets, extending a land lease, and, here's the kicker, paying down debt. Paying debt now means less interest later, which means more free cash to distribute. Picture your prawn mee bowl. Bigger serving, more ingredients, but the same price. Owners get more value, but the kitchen has to work hard not to dilute the stock. Debt repayment will drop aggregate leverage to 33.5%, freeing up $770 million for future investments. Less risk of being over-leveraged is music to any Singaporean investor's ears. Recap. Smart use of proceeds keeps your investments safer, especially with rising global rates. Each REIT is like catching the MRT during peak hour. Cost of debt is your fare. In H1 2025, Keppel DC REIT dropped average debt cost to 3.0%, thanks to a more stable interest rate environment. For data center REITs, who are always hunting for capital, lower financing costs mean more to distribute. Less loss to interest payments lets investors see better distributions. Keppel DC REIT's portfolio reversion rate hit a strong 51% in H1 2025. Like getting major HDB upgrades, rental income up, net property income up, all thanks to market power and anchor tenants. Revenue was up 34%, net property income up 37%. Cost of financing down 5%. The gears are working, even as the market worries about sector saturation. With hyperscale clients giving stability but risk of concentration, plus Japan's foreign exchange risk, the expansion isn't risk-free. Maintenance and enhancements mean more capital spending. Like owning a condo, even in good times, you need an umbrella in case the rainy season hits. Table walkthrough. You'd see risk categories: customer concentration, currency, capital intensity, interest rates, regulatory changes. Each one has a mitigation column: diversification, hedging, careful allocation, low regulatory risk for now. If you love stable, growing income and trust Keppel DC. REITs management, full rights participation keeps your slice and gives exposure to future growth. Tactical investors may opt for partial participation. If you think sector valuations are peaking, maybe sell some units and use the proceeds for the rights issue, locking in value, staying nimble. Big REIT holders, new investors, rights periods may see temporary price dips. Opportunities for those waiting on the sidelines. For my personal take, I've been covering Singapore REITs for years, through S-REIT rallies, pandemic dips, property booms. The difference this time? Structural demand from AI workloads and Japan's long lease profile. Tokyo DC3 brings accretive DPU, long-term inflation protection, and solid lease security. That means, despite apparent yield compression, overall dividend income is poised for steady growth. Temporary yield compression to 4.06% isn't a loss. It's resetting for stronger, more stable dividend growth. The combination of reduced leverage, strategic location, and AI-driven demand sets up Keppel DC REIT for the next wave of distribution stability. If you're looking for a step-by-step playbook, full visual tables, portfolio checklists, my full REIT strategy, check the written version on Substack, link below. Iggy's verdict? View rights periods not as threats, but as chances to actively rebalance, secure long-term growth, and sidestep market volatility. Like, share, and subscribe if you found value. Consider becoming a channel member. Get early access to premium content, special webinars, and the full Investing Iguana playbook. If you want a deep dive into REIT comparison or Singapore dividend income trends, the next video after this covers the ST index shakeup and how it changes sector allocations. So are you ready to make the most of this rights issue? Drop your questions, experiences, or worries as an investor in the comments. Let's build smarter, stronger portfolios together.